Hey YouTube, this is Leo with DRIPCalc, and I want to share a good news with you. I bought a new stock, and it is an oil company. And so if you look at my channel, I made a video a few months ago named "Is it time to buy oil stocks?" And in that video I actually say that no, it's not time to buy oil stocks. And since then oil price is actually down, while the share price of ExxonMobil is actually up. And so if you guessed, I did not buy ExxonMobil, I bought BP. Alright, so in this video I'll tell you all about it. And before we begin, just a quick public service announcement. So my channel is almost at 300 subscribers, so please help me get it to 400. Please smash that like button, subscribe to the channel, and that will really help my channel show up in YouTube, and so more people can see it. Let me know what you think about BP and ExxonMobil and my analysis of these two stocks in the comment section below. And also in this video I'll be using the DRIPCalc compare tool and the DRIPCalc stock research visual stock research tools. So if you want, you can try this completely free. I'm gonna put a promo code in the description below. We offer a lifetime 30% discount as well as a 2-week free trial. Okay, so with that said, let's begin. So why did I buy BP? Okay, so like 3 years ago I used to own BP at about $28, and I sold cover calls and I was assigned, and after that the price ran up, and so I haven't had it for a while. And recently in the morning it dropped to like $32.50, and that was pretty much my target when I wanted to acquire it. And as soon as the market opened, it went up a little bit. So I owned it at $32.51, and I also sold the covered call and ending in the basically January 25, and collected like $1.20 for that. That was a $35 strike. So if I get assigned, I'll make like 10% plus the dividend in 4 or 5 months. So, but that's not why I bought BP. So this will be an in-depth look at why, basically, why I don't like ExxonMobil at these prices and why I got into BP. So first of all, this chart here, this is this is total return of the two stocks, and let's load 20 years. Because we want to look at some data, some interesting data. So if you invested in both of these companies 20 years ago, ExxonMobil has returned almost 400% in 20 years. It's not so great compared to S&P 500, but if you look at BP, the return on BP was horrendous, just 65-66% over 20 years, and it is much better demonstrated here on the chart. So up until basically COVID times, the returns on these two companies, they were much more comparable, but after COVID you can see ExxonMobil just took off, whereas BP kinda went up but not really. And it is actually even better demonstrated if we load this for 4 years. We'll come back to 20-year mark, but look at this. So this is like beginning of COVID, a little bit into it, couple months, but basically since that time ExxonMobil is up 222%, and that's with dividends reinvested, and BP is only up 76%, which is kind of pathetic. So if everything is so bad for BP, why did I get into this stock? And let's start over here. So we have market cap for ExxonMobil. So right now it's sitting at 520 billion, give or take. And if you look at market cap for BP, it's 91 billion. So Exxon is 5.5 times bigger in market capitalization. Okay, so now we're going to skip dividend for now, although BP offers a much better forward yield, almost 6% versus 3.2 for ExxonMobil, but we'll skip that for now. Let's go to our handy dandy free cash flow. Okay, so over here, this is the last quarter. So free cash flow for BP was $4.64 billion. That's actually the money they get to keep after all the expenses are paid. Okay, and free cash flow for ExxonMobil was $4.3 billion. Now, the previous quarter, it was really low for BP and much better, like $10 billion for ExxonMobil. As you can see, these numbers, they fluctuate more for Exxon. So if we jump over here, so these last couple of years, they were really great for all oil companies. And over here, they were barely making money. Well, I mean, still like 6 billion, you know, 2.5, 3 billion. That's nice. But you can see over the last 10 years, they weren't printing that much money. Over here, before the great financial crisis, they were also printing a lot of money. Okay, so if we look at BP, the situation is similar. So the stretch between great financial crisis and COVID, they were making money, sometimes losing money, so that's not good. And before great financial crisis, they were printing money. But overall, like, look at this. This was like the best quarter for both of these companies. BP made almost $10 billion in free cash flow, and ExxonMobil made almost $20 billion in free cash flow. But don't forget, ExxonMobil is 5 times bigger than BP, 5.5 times. So by this logic, they should have made 50 billion over here, but they only made 20. So basically, in terms of share price, BP is earning a lot more money per share compared to ExxonMobil. So if we look at free cash flow per share, right over here, so free cash flow per share for Exxon was almost $5 over here during the best quarter, and it was almost $3. I mean, more than $3 for BP. Again, BP is 5 times smaller, so they earn a lot more cash per share compared to ExxonMobil. And so the results, the end result, is that BP is raising they just increased their dividend by 10%, or almost 10% over here, so 9%. And ExxonMobil over the last 10 years has increased their dividend by an average of 3.25%. Last year they increased it by 4.4%, and I expect this year they will increase it by 3 or 4 cents, probably by 3 cents. So it'll probably be 98 cents. And so BP just increased it, so they're going to keep it. Now, as far as dividends, let's take a look at this chart right here. So you got to look out more than 10 years. You can see that ExxonMobil is actually excellent dividend payer. Even over here, when they were losing like 5 billion per quarter, they kept paying dividend. They did not decrease it. I mean, they didn't raise it, but they didn't decrease it. You know, so that's a good sign. BP, on the other hand, you can see already here they dropped the dividend during COVID time. Actually, and let's zoom out. So over here, great financial crisis, they kept paying a high dividend until like the first quarter of 2010, and then in the second quarter they dropped it. Okay, that's when oil prices really went down, but they actually kept paying fairly high dividend for a while. They dropped it, but then they quickly raised it. Here they dropped it again, but then they quickly raised it. But anyway, we're looking forward. So if we have a massive recession and oil prices go down, most likely BP will be dropping the dividend. That's given their history. And basically, American oil companies, they usually don't drop the dividend. You can also look at Chevron. They also keep raising the dividends. So let's look at Chevron. So ticker CVX. And Chevron stock is not doing that great. I don't know why, but anyway. So they raised the dividends all throughout, even during the recession. So 2008, see over here, they raised it into 2009. They kind of kept it flat for a little bit, but then they raised it. So over here during COVID, no, here's the COVID 2020, they raised it in the first quarter of 2020. So that's exactly when COVID began. They raised the dividend, they kept it flat for a couple extra quarters, and then raised it. So they're raising their dividend much faster than ExxonMobil. In the last 5 years by 6.5%, and over the last 10 years they raised it by an average of 4.3%. Anyway, back to BP. Why am I buying BP? So this is a dividend payout. It is based on EPS, okay, earnings per share. And if we scroll down a little bit, we can see that EPS for BP in the last quarter was negative 5 cents, and they lost, on paper, they lost, where's the net income? So this EPS, free cash flow, where's the net income? Over here, $129 million. But guys, this is EPS or net income, and these numbers, they can be played via creative accounting, and a very good example of that is Coinbase stock. So they just reported Q2 earnings, and you can see they only made 14 cents. However, free cash flow per share, they earned $2.75. So how is that possible? And if we scroll down, free cash flow for the quarter for the whole company was $677 million, which is much higher than the previous quarter, when they earned a much higher EPS of $4.40. So 14 cents versus $4.40. So this is creative accounting, and basically the way that Coinbase did it is over here they took a paper gain of like $760 million on the increase of value of their crypto assets. And then price of Bitcoin dumped in the second quarter, so they took a loss of $320 million. But that's a paper loss. They didn't actually lose that $320 million. It's paper loss. You can see their actual free cash flow, the actual money they earned, went up by $260 million versus the second quarter when they made a lot of money, supposedly. I mean, they did make a lot of money, but a lot of that was on paper. And you can see the results in the cash position. So their debt is virtually unchanged, okay, but their cash position went up by more than $1 billion from quarter to quarter, while they only made like $36 million in net income. And that's because of the free cash flow. Maybe they sold some crypto assets. I gotta look deeper into the quarterly report, and you can see they actually did not dilute the shareholders. So from Q1 to Q2, their shares outstanding actually went down. So this is the example of creative financing, and that's why going back to BP, yes, they have negative income, but they basically took a write down on some not even paper assets, just a write down. So they, in the income statement, they reported as a loss, but the actual cash flow, it actually went up. So if we look at the cash balance and debt, their cash went up more than their debt. So their net debt actually decreased. So debt minus cash actually went down, whereas for ExxonMobil, it went up. So over here they had 33 billion in cash, and here they end up with 26. So that's 7 billion difference, and their debt went up. And that the net increase in the debt was $11 billion. Okay, and also you can see ExxonMobil revenue went up quarter to quarter. Okay, so almost $1 billion, but that's a result of their acquisition of Pioneer. I think they acquired Pioneer, ticker PXD. I don't think it trades anymore. Yeah, Pioneer Natural Resources, I believe. They acquired another oil company, and that's why their revenue went up. So for BP, revenue went down a little bit, and they actually missed on the revenue, and that's not a very good sign. But part of it was because the oil prices actually were lower, but whatever. So they missed on revenue. Doesn't matter why. Hopefully they will recover. And yeah, ExxonMobil increased revenue, but that's at the expense of Pioneer. I think if they didn't acquire Pioneer, their revenue would be lower also. So if we look over here at shares outstanding, you can see they increased the outstanding shares by 8% quarter to quarter. So they basically diluted their shareholders. Again, part of it was the acquisition of PXD, Pioneer, but the free cash flow is lower this quarter than a much smaller company, which is British Petroleum, BP. So looking at all of that, basically the Shell and the BP, the one is Dutch, one is British, they are trading at a discount compared to American oil companies. So Chevron, Exxon, we have Occidental. So basically, if you look over here at P, I think this is a little misleading because this is trailing P, and the PE for Exxon is kind of high. But I mean, per share, if we exclude this negative quarter over here, BP is just making a lot more money per share compared to ExxonMobil. Like you can see $3.50 over here versus $4.68 per share for Exxon. But the prices of the share price of BP at that time was about 3 times lower than ExxonMobil. So you get a lot more money per share. And I think it is really, in my opinion, it's kind of underpriced right now. So I thought it was a good time to get in. They offer a really great dividend yield. Now, if we have a bad recession, they'll probably reduce the dividend. But I think that would be a really good time to increase my position. Now, I didn't do a lot. I only did 100 shares and immediately sold the covered call. So I reduced my actual cost to $31.30. So I'm already up on cost. And if I get assigned, I mean, I make more than like 13-14% in 4 months. That's a really good return, probably beats S&P 500. If I don't get assigned, I will collect the dividends and keep reducing my share cost or cost basis, you know, average down, and maybe build a position. Anyway, so that's why I bought BP. I think it is a good company, good oil company to buy at this point in time. Basically, the way I think about the whole oil industry, I think we are in a commodity super cycle, meaning all commodities will basically go in price tremendously in the next 10, 15, 20 years. But right now, the macro, we might face a bad recession, so oil prices might drop to like $40, $50 again. Will they? I don't know. But if we hit a recession, they will be below $50. And I think right now, ExxonMobil is really overpriced, guys. So if we look over here, this is the share price of Exxon. Let's do 5 years. So this is the middle of a recession. The worst recession read over here in the summer of 22. It was like 9%, and oil hit $140. ExxonMobil was $100. Okay, then oil kind of started dropping over here at the end of 22. Exxon was at times it hit 120, but basically 115. And as oil price is going down, the price of Exxon is going up. I think it's completely ridiculous. It's overpriced. And when oil prices were around $50, Exxon was $60. So I think that Exxon should be trading much closer to the price of barrel than it is trading right now. I think it's way overpriced, and those valuations will come down, and people will be very unhappy. And that's when I'm going to start accumulating ExxonMobil, when it goes to $60 or even below that. At this point, I'm not buying any ExxonMobil. I do have a position in it, but I bought it over here in the $55 range, $50, $60 range, and I keep my shares. I keep collecting dividends, selling cover calls. So my dividend yield is rising, my cost bases are going down, but I am not reinvesting the dividends into Exxon stock. I think it's way overpriced. At the same time, you can see, let's take a look at 5 years of BP. Like, it peaked over here at 40, and now it's $33. Now, if we look over here at the total return, 400% in 20 years. Now, do you think that at this point it is easier for ExxonMobil to add 30% market cap, basically going to like $160 from here, or even $170, or it is easier for BP to go from $33 to $40, which is also like 25-30% market cap? I think it's much easier for BP to go to $40 than it is for ExxonMobil to go to 160. So I think I have a lot more upside with BP than with ExxonMobil. In my opinion, Exxon has only one direction, and that's down. I have no idea why people are buying it at these insane valuations. I think once it goes over $120, I'm going to start shorting it. Anyway, so one more thing I wanted to talk about over here in the charts, and that's dividend safety. So this is net income versus dividend payouts, and so we have about 46% payout ratio. It is very good. It is very safe. So they make about 60% more money than they pay out in dividends, and free cash flow to dividend is actually not looking so great for ExxonMobil. You can see it jumps between 40% and 100%. That means for every dollar in free cash flow they make, they pay out $1 in dividends. And so this is again creative accounting, and the free cash flow is the actual money that they have left after all the expenses are paid, after all the taxes are paid, and all of that. And that's when they can do share buybacks and dividend payouts. Now, if they're paying 100% of their free cash flow in dividends, how are they going to do share buybacks? You kind of have to split the free cash flow. You don't do share buybacks out of net income, you do it out of free cash flow. And so I think in that department, in the last quarter, because this is only last quarter, the previous quarter it was only 40%, 50%, 33%. So it is rather safe still. BP over here, free cash flow to dividend payout 26%, much better than Exxon, but overall I think they're sitting around 33%, 30%. This was an outlier, 94.5%, but overall they're in a range of like 20 to 30% free cash flow to dividend, which makes them even more safe dividend player than ExxonMobil. Again, over here they had an actually like a loss per share on paper, so this ratio went negative, but in reality they're sitting around 40. Like they're all over the place because they take paper losses. But I think both companies are very safe dividend payers, and so even if the oil price drops tremendously, for a prolonged time, not for a short time. Like if it drops for a couple months and then recovers, both of these companies have plenty of cash to pay dividends. You can see $35 billion for BP, and actually less, $26 billion for ExxonMobil, but I think they will increase their cash position as time goes on. Over here they're sitting on $3.5 billion of cash, whereas BP, their cash actually usually stays pretty elevated compared to ExxonMobil. So yeah, that said, I just see a lot more potential for BP. I think it's way underpriced right now, and in general BP compared to like American oil companies is much cheaper. So with that said, we recently announced our dividend retirement calculator, and basically this tool helps you calculate how much you need to invest right now to receive a certain level of income, dividend income, in the future. So you can plug in how much you want to make. So by default we put $100,000 here, years to retirement. So let's say you're 20 years from retirement, and it loads the latest price for the share. So you can put the stock ticker here, load, and it will provide, this is the latest share price and the dividend, and also these two metrics. This is dividend growth rate and share price increase rate. So ExxonMobil in the last 10 years increased their dividends by an average of 3.25%, and that's the number over here. So that's the number you're more or less likely to expect. Again, if we go over here, you can see negative dividend CAGR for BP, but that's because because of all of this good stuff. You know, they raised it by a lot. Like this is a huge increase in dividend from 65 to 84 in 1 year, but then, like, you know, great financial crisis and they reduce it. So you have that possibility if something happens to the economy. I think unless oil goes to $40, they will not be reducing it anytime soon, and it has to stay there for a while for this company to basically not break even. Anyway, so I think in the long term BP will raise their dividends at about 5-7% per year. And so going back to this calculator, if let's calculate it. So this is the $100,000 of income goal after taxes, okay? And so this calculator estimates that you would need to put down $935,000 today, so almost $1 million to get $100,000 after tax income in the retirement. So that would be $123,000 per year, $124,000. Once you pay taxes out of it, you will be left with $100,000. Okay, now here's the thing. So like I said, I bought ExxonMobil in a $55 range. So if we, because, and I think actually it will go down. It will go down below 60 in the, I'm not going to give a timeline because I don't know how long, you know, they'll keep pumping the economy just to show positive numbers. But I think it's coming to an end because we already had a, you know, a yen carry trade unwind and a huge market drop on Monday of this week, and I think it's only the first signs of it. I think once the elections happen, they will stop, you know, keeping economy on life support. I mean, we have $35 trillion of debt, and are spending more money to pay the debt than we spend on the military. So, I mean, how long can they do it? But basically, if the price of ExxonMobil goes to 55, instead of putting up almost $1 million, you only need to put down $192,000, and you can actually play with it. Let's say that you add $250 to your investment account every month. Now you only need $167,000, and if the price drops to $55, then it will, once the whole, you know, like recession thing ends, I think the share price will start growing like crazy. So I would put like, you know, 3.5% here, which is probably too pessimistic, but whatever. So basically, if the share price grows by, let's say, 5% per year, and I think they at some point can increase the dividend by, like, say, 4% per year. So, and let's say the share price is $55. Guys, don't forget, just a few short years ago, 3 years ago, the share price of ExxonMobil was $43, no, $32. But even over here, like, this was not COVID anymore. It was $55. That's when I was buying it. It was dropping, 54. So it is very possible that we'll go there again. Again, I think it's way overpriced right now. I think we're going down in the near future. So I would put 55 over here, if we calculate it like that, and let's say you don't have $235,000 right now, but let's say you can add $500 into your account every month, so that's like $6,000 a year. You would only need to have $188,000 to invest into ExxonMobil, and then in 20 years you will be collecting $100,000 in dividends. So by the way, this number will be increasing in a couple of months, so I would put this at 98 cents, and then you only need, because this will increase, we already passed the last 95-cent payment, so it will go up. Let's say it went up by 4 cents, which they did last time, so that would be 99 cents. See, it makes a huge difference. So now you only would need to put down $167,000. Now let's do the same calculation for BP. Okay, so we loaded BP price here. This is the latest dividend. I think that dividend will grow by about 7% per year, and share price kind of stagnant, so let's call it 0, because it's all over the place. If you look, the share price of BP actually went down over the last 20 years. So it's ridiculous. If you look at 10 years, so here the price was $47 and now it's 33. So I don't know what BP share price will do, but at this point, like short term, I think it has a lot more potential to go up 30% compared to ExxonMobil. So let's keep it at 0 and calculate. And now we only need $57,000 to invest in this company, and in 20 years we'll be receiving $100,000 in dividends over here. So this is the last year of accumulation, year 20, and in year 25 it shows $125,000, and that includes a because these are qualified dividends, so you need to subtract 15% for the federal capital gain tax, and also my state tax is 5%, and that's combined rate of 20%. Therefore you would need $125,000 gross to make $100,000 net. I think it is very very likely to get there. And then if you add, let's say, $500 a month, how much less you need? What? $54? Okay, that's unrealistic. Let's change this to 5% and change this to $250. Okay, no, I think 5% is probably, yeah, 5% is more or less realistic. So you would only need right now 100 grand invested, and then adding $3,000 per year to your investment account, and at the end of 20 years your total investment would be basically $158,000. Your total collected dividends will be $667,000, 68, and you will be getting $125,000 per year in dividends before taxes, and then that will continue on growing. Now this is a straight line estimation, nothing happens in straight line, but I think BP will do just fine in the long term. It's not going anywhere, and I think it's a very attractive price right now. Now again, if we have a recession, BP might actually drop to like $20 or below, and Exxon might drop below 55, but we never know. And so I'm looking forward, and that's why I opened the position, and we'll be adding money to it. Okay guys, so that's it. If you have any questions or suggestions, if you don't like oil stocks altogether, then just let me know in the comments. But if you're open to investing in oil stocks, I think between these two companies, I like BP much better. If you agree or disagree with me, let me know in the comment section below. Again, I ask you to smash the like button, subscribe to the channel, and once again, you can access all these tools over here. You can access them and get a 2 weeks free trial, and we offer a 30% lifetime discount. So when we increase the price in the future, your price will remain the same, and we constantly improving this tool. So right here we recently added revenue estimates versus actual. So these are the estimates for ExxonMobil going forward. I need to fix it to show, see over here it shows last 5 quarters of the actual revenues and the analyst estimates going forward. So I need to limit the number of estimates showing because that you don't actually see the previous earnings. Same over here for EPS estimate for each of these companies, and then net income, EBITDA, and all the good stuff. Also recent additions, all the net profit margins and gross profit margins for each company. Also price to earnings, price to sales, and all of that good stuff. So we'll be adding a lot more tools, and over here you can basically compare the two companies side by side, see which one is better. You can also research one stock at a time by just searching it over here, and the compare tool is over here at the top. So thanks for watching, guys. Please let me know what you think about my analysis of BP in the comment section below.